Quality of earnings report plays a key role in your M&A due diligence. I recently had a commercial loan broker ask me if I have financials that have been audited, do I really need the quality of earnings report for my client? So I wanted to do a brief breakdown of what it is and the role it plays compared to other documents. So what is this quality of earnings report? It's an independent transaction-focused analysis, and it has a single goal of answering what's really happening in this business. If you're brokering an M&A deal, then it's what is really happening in this business that I am looking to buy. Is the story that the owner, the seller, is telling me accurate? So this is going to go beyond the headline EBITDA, how much money you made each year. It's going to break out the recurring revenue from the recurring expenses from the one-time expenses and one-time revenue. It's going to validate what is a reasonable projection of sustainable cash flow for this business. And it's going to be performed by an independent accounting firm, so you get rid of any questions of validity. And it's going to really be standard practice in your private M&A mergers and acquisitions deals. So when you look at the landscape of all the different financial statements, there's going to be a couple of key documents that each has its own role. We've got our tax returns. Now these are set up for tax compliance, and the goal in creating those is most often to minimize income, right? So they're going to look different than your standard financials. And these are going to be the ones that are prepared on a monthly, annual basis for the company to give the leadership an overview of what's actually happening and where the company is going across the board. And then you have audited financials. Now these are going to be compliant. They're going to be most likely done by an independent third-party accounting firm to really make sure that those financials that were prepared by the company are actually truly accurate and there's nothing missing or funky going on. And then we have the quality of earnings. Now this is going to be more of a deal grade analysis that's really looking at how ready is this company for the acquisition. And it's not the same as an audit, right? Because an audit verifies compliance with standard accounting practices. It says you're doing your accounting well, your books, your financial reports are accurate. But the quality of earnings actually looks at different things. It's answering the deal-related questions like, is the EBITDA that you are citing in your financials actually sustainable? Or was that a one-time freak occurrence and you don't want to base your purchase on that EBITDA projection? Which revenue is going to be recurring versus a single occurrence? What is the real cash flow that you can expect from this business that you're considering buying? And where are the risks? Where are the opportunities? So the quality of earnings is built for buyers. It's built for lenders to analyze a deal, an acquisition. It's not for the accountants to really just focus on understanding the numbers. So what does it examine? Well, first of all, it's going to be looking at revenue quality. We've talked about a number of these, but it's got the recurring versus the non-recurring, the cash versus the non-cash components, how they break out. It looks at customer concentration, whether there's an overemphasis on a small group of customers. It also looks at sustainability. Can these projections be replicated? They're normalizing any adjustments. They're looking at one-time off gains or revenue or cost expenses. They're looking at trends in the margins. Is the profitability going up every year or is it going down? It's also looking at risk. It's looking at internal control gaps where things might not be well controlled and you might see a lot of vacillation, variation. It's looking at any issues they might have in their accounting practices, any working capital issues where they're undercapitalized, lacking liquidity. And it's also going to be kind of bridging a gap compared to tax returns, because as I mentioned, tax returns are optimized for minimum tax liability. In other words, show that we're earning as little as possible so we can pay as little taxes as possible. So that means that companies are often accelerating their depreciation. They're adjusting owner compensation strategies to, again, minimize taxes. They're playing with the timing of different transactions to adjust for tax implications. And the quality of earnings is going to bridge that gap because it's going to take your tax basis and really rework that for your economic basis, your economic reality of what's happening in the business. It's going to identify all of those owner add backs and how they're going to impact the overall revenue you can expect from the acquisition. It's going to normalize to what is a sustainable, repeatable, realistic to expect EBITDA. And so this is critical in many cases, and especially critical when you don't have audited financials. So what do buyers get from a quality of earnings report? They're going to get a much more accurate valuation, a much better feeling for what the company actually should be valued at, because you know how stable it is, what risks are associated, and reasonably what it's been earning and can expect to continue earning. So it's also going to give you leverage to negotiate. It brings the various parties, the buyers, the sellers, together on a single evaluation that's done by a third party that's disinterested in the outcome. So it's more trustworthy. It identifies risk before closing so that you're not stuck with it as a borrower, as a buyer. And it gives you guidance on how to structure the deal, right? It's going to give you any pegs on working capital, if there's any indemnities that you need to be considering. It really helps you figure out how to structure the deal. And it's also going to give you confidence in the numbers, which allows the transaction to move forward more smoothly and more quickly, consequently. So what do lenders get from a quality of earnings report? Well, they're able to underwrite based on sustainable cash flow, not on just the headline numbers, EBITDA over the past 2 years or 3 years. It's going to help those lenders also identify the risks that would impact the debt service coverage. So the ability of that company to generate the revenue that's going to pay off the debt associated with the acquisition of said company. So it's going to help the lenders identify those risks that could leave the company not able to maintain its debt service and consequently leave the lender high and dry. It's going to help those lenders structure their covenants appropriately, right? They're going to be able to determine what they need to have tracked regularly. They're going to be able to set reasonable timelines for amortization. They're going to say, hey, this is how much you need for capital reserves based on this verified third-party quality of earnings. So it's also going to give them the ability to move faster because someone else has done that analysis and now you're bringing it to them. It's a credible, independent, disinterested analysis so they can trust it. And so this is especially going to be valuable in the smaller business market, as well as some smaller, lower mid-market transactions where there's varied financial reporting. And it can also fill in, to a degree, the audit gap, right? Because many private companies, especially on the smaller side, are going to lack those audited financials. So it's going to become the transaction-grade alternative to those audited financials, right? It's going to validate the earnings quality, the durability, i.e. will it continue? It's going to provide confidence for the pricing, for the financing, for everything. And it's going to deliver the assurance that the buyers and lenders both need. And that's why it's so routine in M&A transactions. So key broker takeaways here. Number one, you want to scope early, right? You're going to look for getting that information. The earlier you get the information, the earlier you truly have a picture of what's going on, the earlier you can deal with the complexity that needs to go into the structuring of the deal. It's also going to allow you, you're going to use your quality of earnings to determine a lot of different factors on the deal, right? It's going to help you shape what you expect if you're representing the buyer and helping them get financed. You're going to help them in the negotiation process with the seller to shape what considerations need to happen in order to make this a safe acquisition. For the lender, what covenants need to be in place. And you're going to bring everybody together with those outputs and use it to establish a common understanding of what a normalized EBITDA, what reasonable projections are for durable, ongoing earnings from this company so that everybody's on the same page. You're also, as a broker, going to use it to bridge the gap when you don't have audited financials, the books are very tax focused, anything along those lines. Your quality of earnings is going to provide that decision clarity, right? It's going to give you that source of truth, if you will. And along the way, because it's doing all of these things, it's going to accelerate deals for you. Really, it allows you to move faster when you have it in hand. So the bottom line is that quality of earnings, good reports, help you to create deal certainty. It transforms financial statements into actionable intelligence that everyone agrees to, and that gives buyers confidence, lenders comfort, and gives you as the broker the tools that you need in order to close deals faster. If you have any questions, please add them to the comments below or reach out to us. We're at commercialloanbrokerinstitute.com, and we are always here to help any brokers, no matter where you're at in the journey in this industry, to make your brokerage a success.